Hello, everyone. Today, we are going to go through the full process of valuing a startup. We are going to come up with a startup on ChatGPT, and then we're going to make its financials projections and then make the valuation on Equidam. So kind of really guide people through like how does the process physically look like, how does it practically look like, and then as we go through we're going to talk about important things to look out for. We're going to talk maybe a bit about the theory and how to do things in actual Excel, and then how to do things on Equidam as well, which is the only way to make this in less than like a number of hours that wouldn't be practical for a video. So let's hope this is valuable. We hope this is valuable for you, and it's our first video of this series. We want to do it for different business models, for different types of startups. We're going to start with a software SaaS startup, but you'll see that most of the recommendations are general enough for any kind of software startup and pretty much any kind of startup overall. So I'm here with Dan today, and he has come up with ChatGPT with a startup that we're going to try to value. So do you want to tell us a little bit about the company? What does it do, and what's the stage and so on?
Sure. Yeah, I'm looking forward to going through the full process, going through all of the qualitative and quantitative factors that drive the valuation, and this should be an interesting demo company to do it with. So I guess to begin with, the company we have come up with, or ChatGPT has come up with, is called Energy Pro. It's a UK-based SaaS startup that helps businesses manage their energy consumption.
Okay, nice. And I guess they make hardware, or do they just interface with the energy providers and just provide a dashboard kind of thing?
Yeah, exactly. Just a software solution interfacing with smart meters that are pretty common all over the UK now.
Yeah, awesome. See, like a fairly simple fee per building or something like that they need to attach to the power
Yeah,
meter.
I guess it would be maybe something like a subscription fee that increases based on your consumption, perhaps. If
Yeah.
consumption is maybe like an interesting proxy to understand how big a business is.
Nice.
And
Yeah.
that we could say they do real-time monitoring, they do some predictive analytics for future consumption for budgeting purposes, some automated energy management, perhaps using kind of IoT, smart heaters, that kind of thing.
Nice. Interesting. Okay. So to start this, we need to start from the financial projections, just because the rest, the qualitative stuff we saw, it's pretty easy, right? So we're going to use our financial projections template, which is online. If you just Google Equidam financial projections template, and then wherever you're looking at this video from, we're probably going to link the template. Let me share it. Right. So let's start. So this is our template. We have a summary page, but we're going to start from the revenue side, right? So we can use quite a bit of this template. We don't need to modify a lot. We can assume that they are acquiring new customers with paid advertising, right? Maybe some events, maybe like where SMBs goes. But if they sell to small, medium businesses, like advertising. And like, what kind of stage are they now? Like, do they already have revenue? Do they?
Yeah, let's say a small amount of revenue, maybe in the like 300,000 to 400,000 range. Enough to
Well,
like
that's
prove
not too
that the
bad.
model has some worth.
Okay. Yeah. Okay. So then I guess we're gonna do a valuation to go for a Series A, or like a larger type of seed with this type of
Yeah,
level,
let's say
right?
a
In the
large
UK.
seed.
Yeah. Okay. Nice. So we can definitely do that and start from the revenue side. So if they are already at 400K revenue, they are probably already spending maybe like 100K in marketing. I'm going to come up with these figures. Like, we don't have them, right? A lot of them. But like, if you are valuing the actual company, you should have these ones, especially for the past, right? Especially if the company hasn't started yesterday. if it has started yesterday and you don't have any past figures, like just use as many things as you have from the actual data of the company, and the rest is going to have to be assumptions, and that's fine and that's totally normal. But that's what we have to do in this case. So it's in the UK. We're gonna do this in euros just because I cannot change the currency of everything. But like, let's imagine that's pounds, and we'll do. What's the ambition of the company, right? Like, do we like? There are some of these type of companies that are pretty successful, but unless they go out of the niche, like it becomes still like a fairly like it could be a big player, but not like the next Facebook or so. Um,
Well, I
yeah,
guess I mean, in the kind of sector that they are doing what they're doing, like there's not much in the way of like regulatory barriers for expansion, I would imagine, and
yeah.
it's obviously like attractive all around the world, especially across Europe. This kind of solution is going to be very popular. So I think you could say
Mm.
their expansion plans are pretty ambitious.
Yeah. So let's say like in this like specific software, like definitely UK leader and then maybe European leader later on. Okay. So we have a
Mm-hmm.
fairly ambitious strategy, and as long as there is no churn or like there is little churn and the product works, we can really push on the advertising, right? So let's start with like some a bit more random, like 50%, but let's see where this leads us, right? One cost per click. This brings all these clicks to the website. And then we have organic growth. Let's start with previous 12 months, maybe 200K visits. And it grows a bit more normally. They do some PR, right? They are going to be in the news a bit. Okay. So this gets us to the number of visits. And then we're going to have a conversion rate to paid. I mean, the conversion rate, it is a bit of an involved product, right? So like conversion rate directly online might be like maybe a little bit lower. Let's start with these assumptions, see where we go. And then product mix, we could think they have a couple of subscriptions, right? Like one where they only do the monitoring and one where they do the automated energy management as well, right? So the second
Mm-hmm.
one kind of costing a bit more. And maybe
Yeah.
the second one only getting 25% of the users, and then a fairly small churn rate, right? You're not gonna get much churn on this type of things if it works well. And I mean, at least in the projections, you should assume that it works well. then
Yeah.
then
I
we'll
mean,
see.
I'm imagining and getting quite attached to this company already, bizarrely, but imagining that they would say, the cost of the subscription is covered by the cost of the savings. So, it should, in theory,
Exactly.
like
Yeah,
nobody should
fair,
ever churn.
fair. And what do we think? Active subscribers. Well, this we will have to see because we have the revenue. Normally this company would have a price. This is average monthly price. So if they sell to businesses, right, you would expect it to be, yeah, exactly. Well, on the second account you can save money, right, because that one is the one with automated management, energy management.
Mm-hmm.
But on the
Yeah.
first type of account, it's only just the monitoring. So maybe the first one costs like, yeah, £15 per month just to get people in. And then the
Mm-hmm.
second one that provides the savings then maybe costs like 80,
Yeah.
right? And this gives
That's
us
the
a weighted
upsell.
average. Yeah, gives us a weighted average of about 35. So that means that if we have 350K in revenue, we need to have, let's how many customers, right? So 300K divided by 35 times 12, right? So that's going to be the early. I'm trying to just get to a number of customers that make sense to begin with,
Mm-hmm.
which is again is data that the company would have, right? So then this is
Yeah.
going to be 25% on the big account, and then 75% on the simple subscription, let's say. So we
Mm-hmm.
start with 700 customers, and then here, because of our assumptions, which again now they're very big assumptions because we don't have anything of this, it's a little bit too much, isn't it? So maybe we start with higher cost per click, and then we get, okay, yeah, I like that. So the company is growing
There's
pretty
5.5
quickly.
million SMEs in the UK. So
Yeah,
Yeah, I think that like that model should work out at scale, assuming they can capture a large part of that market.
Yeah. Yeah. So like this, like if you see here, the number of customers is kind of like triple in the first year, then double, and then like it slows a bit.
Hmm.
I think it makes sense, but still, if the story is that the company is really going to take over the UK with such a large market size, then we could expect something more. And that's kind of the first actually theory on valuation here, right? It's like you want to reflect the story of the future of the company in these assumptions as much as possible,
Hmm.
and then verify that that story is credible, as much as you can, right? So in the end, the ultimate test is going to be investors. Are they going to believe into that story? But right now, like if we go for that story, this seems to me a little bit conservative, especially when we get to like year 4 and year 5, right?
Hmm.
We want that to grow a little bit more strongly. So maybe um, we start with an increase in marketing budget that is more substantial as the company is growing quite a bit, and then maybe we double our marketing budget every year, and this one gets us to a more ambitious trajectory in year 4 and year 5, which seems more realistic. Maybe this is too much right now though. Yeah, okay. Okay. So still ambitious. We get to be like the UK leader, um, maybe even the European leader. It depends like really what kind of adoption this technology can get. So
Hmm.
um, not too bad. Not too bad.
I'm playing the
We're
role of
gonna,
the founder for a moment, like on the
yeah.
conversion rate. Like maybe I feel like we could do slightly better than point eight, and
Mm,
that would be based in this case on tests we've done so far, testing out different channels, looking at the actual performance.
yeah.
But
Yeah.
maybe I push for like, let's see what point nine looks like.
Yeah, exactly. And this is the idea of this file. Like both you and the investor can really play with these things and see what would be the outcome, right? So
Hmm.
now we're jumping a bit higher in level, like pretty much across the board. Makes sense. We can leave it at zero point 0.9, see what happens. Um, we have here an idea of other revenue streams. So e-commerce sales, like this is definitely not applicable to the company. So we're just gonna put the conversion rate to 0. We
Hmm.
could, if we were really going to raise capital, clean up this Excel properly, like remove all these rows and then just like leave only the important things in. Um, for the calculation purposes, we can just leave this to 0.
Hmm.
And we also need to put this to 0. Okay. We might have some large clients though, maybe not straight away, right? But like if we offer this, we might get some large corporates that are interested in the same thing, right? So let's say we close 2 of them per year. This is year to date. So we start with 0 of these ones. We just started and we really want to focus on consumers, right?
Hmm.
Sorry, active contract, 0. But then we're going to close 2 per year. And then we have, these ones are going to have very low churn, right? And they're going to cost per year. So the normal account is like, the normal account is 80 per month. So that's 1,000 per year, more or less. Let's say big corporate, like maybe 25K per year. They have a lot of offices. I don't know, a lot of emissions.
Yeah, for sure.
They're gonna do
Yeah.
something like this, and our contracts are gonna grow at 40% per year. Sure, okay, just basic assumption, but just to include that in as well, and it's gonna be about 10% of revenue in the end, which sounds fair.
Hmm.
Uh, no e-commerce and outbound sales. Let's assume we just stick to the software side. It's fairly cheap software. We're not going to have outbound sales, but we could have if the company actually, the strategy is a lot more around large customers. We might have to model that in a completely different way. Like this is kind of like modeled as founders sale, right? We don't have salespeople doing this. We close 2 clients per year, which are doable by the founders. But if we wanted to go for a model where we have salespeople, they call potential customers and they convert them, then we would have to model something like this. Um, which again is
Yeah, I
not
guess
not
in
difficult to
this
do.
example, like
But
the
yeah,
large contracts would be, as you said, corporations with offices all over the country who maybe find
yeah,
this solution, but are like, this the basic pricing doesn't work for us, so they get in touch and they negotiate something more bespoke based on their
exactly.
requirement.
Yeah, for sure.
Mm,
Yeah,
yeah.
yeah, yeah. So this one doesn't apply, and we'll just set it to 0 as well. Okay. Let's see about the costs. Again, we have here a blueprint, mostly focused on software. So we start really with salaries, which are going to be the biggest things. I'm not super aware of UK salaries, but we can start with the definitely,
Closer to European than they are to American, that's for sure.
definitely, yeah. But we're definitely going to have some growth here because inflation is
Yeah.
not what it was a few years ago. We have a CEO. We actually have a CPO straight away because the company is already there, and a CTO as well, right?
Hmm.
So
Yeah.
maybe CPO is more like gonna be like a growth officer because we do all our um, growth because we do all our growth online. So it's more like a um, marketing growth, like a revenue person, let's say.
Yeah. Yeah, that
Uh,
makes sense.
yeah, management. So 400K. Let's say we raised the seed round so far, right? To get to those revenues, we're probably gonna be around 10, 15 employees maybe in total.
Hmm.
I would say
Mostly
so.
technical.
Yeah, yeah. We're not. Yeah, because the sales funnel is fairly automated.
Hmm.
The We're gonna have a mid-level management. I think we need to go a bit more. We need to go a bit higher here, right? I'm not really sure of the UK salaries, but
Yeah,
mid-level
seems reasonable.
management. Yeah, mid-level management gonna start when we have even more employees because we do have a CEO and two other chiefs. So I think we start have mid-level management, maybe more around like 20 people. And then we're going to have technology. So yeah, that's not very realistic either. And product development. Yeah, okay, maybe there. Okay. We need a product manager every certain number of, no, it starts in year 4. Maybe this one needs to start sooner if the company expands.
Hmm.
Development engineers, we have a fixed number of engineers for depending on the number of subscribers, and these are just like almost like maintenance, like
Hmm.
people that are need to maintain the software, and then we have extra ones according to the strategy. So we
Yeah.
could go heavier on this one. Yeah, that seems more reasonable. And then we go heavier on the early engineers, and but then this one goes to be smaller and smaller because we're not gonna always keep them, right? So this is like kind of the investment that we're doing now in technology that we
Hmm.
need to raise capital for.
Yeah, makes sense.
Sales. So we said we're not gonna have sales managers, so we can remove them. Marketing. Yeah, marketing we will have. So again, this has like very low salaries. And marketing salary is gonna grow, and we have marketing every 150,000 visits, but maybe that's a bit low. Sorry, yeah, maybe like 50. Yeah, something like that. And then again, we have an initial push that we're doing now, where we're gonna have 44300, maybe something like that.
How do you think about the logic behind those kind of connections, like the number of marketing staff per visits?
Well, right now I'm just like kind of jotting it down,
Hmm.
almost at random, just to see like, okay, if we have like 6 plus 10, 16 engineers, like we're gonna have like 8 marketing. Maybe that's still a bit high. So it's more like these relative aspects because we don't have this data, right? A company would have this data already.
Mm-hmm.
So I'm kind of like jotting it down a little bit, and then we can see at the end how it looks, right?
Yeah. Yeah, it
So
makes sense.
operation and customer support, we might need, right? Because like these people are going to have to be supported, but maybe we need a bit less. Maybe we need one every 2,000. Yeah, okay, something like that. And then customer onboarding, we don't need. We have a fully automated onboarding, so 0.
Mm-hmm.
Okay. And let's remove also the headcount. So yeah, that's better. Finance, yeah, another thing that you don't think, but if you start racking in like 8 million in revenue, you're going to have people in finance just like challenging invoices and things like that.
For sure. Yeah, we know how important that is.
Yeah. And then in this case, we want a person every 2,000 subscribers. Yeah, that, so like this one, like it makes sense. Like we start with one, maybe it grows a little bit too fast. Maybe like it should be every 3,000. Yeah. Okay.
I guess you could also connect the number of like finance and admin people to like growth of costs or growth of revenue
Yeah.
or
Yeah. Yeah,
interesting.
definitely. Yeah. Yeah, you could have a number to each like amount of revenue. On the
Mm-hmm.
cost, like there isn't, well, maybe the number of employees, right? There is a lot of
Mm-hmm.
employee related work in administration. So maybe you could connect it to that.
Yeah,
In this case, because they are small invoices, there's gonna be a lot of work there, I think. So we're gonna link it to that. Yeah.
makes sense.
And we see we have a total headcount that makes some sense. And if you look at the costs here, which is going to be our biggest costs, we are starting at a loss because our revenue were like around 800k, 1 million, but
Mm-hmm.
then we're going to end up in a profit because our costs are only 5 million on 10 million of revenue, and
Mm-hmm.
we can see here the percentage of revenue that cost is. So that's pretty handy. Cost of goods sold, I mean, this one, right? We might have something because we might have to pay the energy companies for their data. I don't know. Every time we connect a customer, or is it just free stuff that they allow
It
people
is.
to?
It's mostly free, and to us that
Probably
could even be
free.
another source of revenue if we're referring people
Yeah.
or recommending providers.
All right.
So
So
I'd say
then,
cost of goods
yeah,
should be pretty low.
yeah, that's true. Like referring, yeah, comparing plans and things like that could be a different thing.
Mm-hmm.
Advertising, right? We already specified it. We are gonna have a percentage of budget as a percentage of sales, so a percentage of revenue. Again,
Mm-hmm.
this is all customizable, right? And but like a small budget for events and TV and radio type of things.
Mm-hmm.
4% of revenue looks all right. And then
Yeah, I think so. Enough to do a few
and
conferences, a
then
bit of traveling.
yeah, I think the traveling, yeah, exactly, it's in here because otherwise we have also traveling for salespeople, but we don't have salespeople. So
Mm-hmm.
technology platform is not going to be super expensive, I don't think, but a little, like we derive here a cost per visit from the data of last year. A company could do the same. Look at the cost of last year and just let it scale according to the number of visits.
Mm-hmm.
Computer equipment, we have 4K per employee, so that seems reasonable. Third-party development, in case it's needed, we have 3% of revenue. Fair, plus 9K fixed every year. Okay. And then banking. Okay, so we're gonna have some percentage of sales for banks, and we're gonna have baseline for bank charges. Okay, yeah, we're getting into small things. Again, companies can look at these things from their previous year and just like expand them. I don't think we need to go through everything. Accounting services, rent, and office, utilities. I just wanted to see, yeah, the travel. So, okay, it's 6K per executive because the executives are gonna maybe travel to trade shows and things like that. and for sales is 1,200, but we don't want to have sales. So other SGA. Okay. Total expenses, depreciations, we don't really have depreciations, and income tax. I'm not sure what's the UK income tax, but can be looked up. So if we want to take a look at the overview now, these are our revenue. This is clearly not correct because we started at around 350K, we said, only on subscription, no recurring contracts, no other things. Yeah. So this a company would have, right, from your accountant, from your internal monitoring of your revenues and costs. Like this, you should have, and it's very important that you fit it in and that you fit it in correctly, because people are gonna use that as a baseline to understand, like, if you can actually achieve the future, right? And so, quite an important thing. Cost of goods sold, we can start, just something that makes sense looking at the next years. Again, this is figures that you should have. They should come from your accounting system and so on. And then wage, like, we can just copy this if we past values. Okay. But it's probably going to be smaller, right? Especially technology development. And 120, let's say, sales and marketing. So we're still growing quite a bit, right? So that's why I'm kind of making this one smaller. Again, this you should have from your accountant.
Yep.
Okay, so we are in a clear loss, right? So we made 350K in revenue last year. We spent almost 800 in people. Maybe a bit high considering that story of like where the company wants to be. Like at this stage, the company would have spent probably less. So let me fix that. Again, this is just us making assumptions on things that shouldn't be. They're not assumptions right now. So, but we have to do something. So, okay.
I'm sure the executives early on would be like, eating ramen, cutting costs wherever they can.
Exactly. Yeah. So, so something like this, right? So we still are at a loss last year. That's why we're raising capital. That's why we raised capital before. But we're also raising capital to really finance expansion of our sales and technology platform, and really go get like the whole market, UK first and then Europe. This is random numbers, like more or less makes sense. It's fine. EBITDA was 200K lost, which makes sense. Probably we raised a seed of 400, right? Like a pre-seed of 400, something like that. And now we're looking for a large seed or a small Series A. Okay. We don't really have depreciations, interest, stuff like that. Doesn't really matter. We have some assumptions here on balance sheet assumptions, which is kind of smaller assumptions. They're not really important, especially for a software business. They become more important when you need to really deal with inventory, manage inventory and things like that. But account receivables, inventory, intangible assets, things like that. In this case, we are pretty much unconcerned with this completely. The level of cash is important, right? So we're gonna, let's say we still have 200 from the initial investment that we got of around 400K. Account payable.
And would that include like investment that founders have made in the company as well?
I mean, like if the company started a couple of years ago and last year they lost, what was it, 250, they raised 400. Either they raised from friends and family or they invested a bit themselves before. And so we are left with 200K, which gives the company like between 6 months and a year in terms of runway. So they don't have to raise capital right now. They want to raise capital right now, which I think makes sense. They have the strategy. They know that the product works, and they want to expand it. Yeah, like you see here, right? Like this type of discussions are more like fundraising strategy than projections. and this is something that I think we always try to stress, that projections allow you to make fundraising strategy discussions, right? So should they raise now? Should they raise in 6 months? Should they raise in a year? How is the losses? How's the burn rate? What's the runway? Like these type of things. What's the runway with our main plan, with our expansion plan, or what's the runway with like a ramen profitability plan? Like how long can we stretch it if we have to? Like all that stuff you can only see in projections, right? So that's why we always say, like, even if the company is very early stage, and even if the projections are extremely rough, like you see how rough these are, right? Like we can make this type of considerations quite easily. So it's very, very important to have even rough projections, I would say.
It's really interesting to me that, if you had an investor you were talking to say, we think you should raise another 200K and start hiring a couple of sales people and pursue those large contracts, you can put that in the model, see what it would look like, see what you would need to get
Yeah,
out of that for it to be successful. And it's a really useful perspective.
yeah, yeah, yeah. And I think also the fact that we are modeling a lot of these costs as like related to the revenue, it allows you to think like properly, not just like, oh, like when we make these things in our head, we oversimplify them, and we don't think about like administration, we don't think about external contractors or whatever it is, right? Think like, oh, we're going to need developers, we're going to need sales and marketing, that's it. But like you need to get to a little level of detail, a little bit more. I mean, you saw, right? This took what, 10 minutes, 20 minutes to get it so far. Maybe half an hour, but yeah, it's worth it. Right. Anything else on the projections? I think we're pretty done. Well, we can specify here how much funding are we going to look for. So we raised 400K. Like how much are we going to raise for the next round? Maybe
1.2 million, maybe?
1.5, 1.2. Yeah. Yeah. So 1.2 gives us, with these projections, it gives us, it almost covers our full negative EBITDA of the next 2 years. Maybe we could stretch it and say, like, so the total here is 1.3. We want to give ourselves a little bit of a cushion. Maybe we should try for the 2 million for that ambitious strategy and then never raise again, right?
Yeah.
Or we can raise again if we find more opportunities, if we want to expand abroad even faster, and so on. So this is pretty great.
I guess
And the rest
that's where you
doesn't.
start thinking about future milestones. What are we raising
Yeah.
to achieve this time? So the 2 million might be
Yeah.
expansion across the UK. And then you'd say, when we get to the Series A, that may be raising to expand into Europe. So that would be like
Yeah.
super ambitious, huge
Exactly.
scale, very expensive.
Yeah, then we would raise like 10 million. We would use like 2 million per country for Germany, Italy, Spain, and something else for marketing. So so this looks good. Like so like with this story, and by raising the 2 million, we create the UK leader in this, let's say. And then we can always see that this works very well in the UK. And like in year 3, go raise, like, as we were saying, go raise 10 million and expand into Europe, and so have much bigger projections for year 4 and 5. So that's definitely doable. Right now, that expansion maybe is a bit like less credible. So if we put in those numbers, we have a higher valuation, but we have a lower credibility. So I would look at what the valuation yields with these numbers, and then we can always adjust at that point. So
And
shall we do that?
we'd probably be doing the valuation based on the first 3 years, I guess, rather than going all the way out to 5.
Yeah, we can test that.
Okay.
The idea there as well is the more years of specific projections you incorporate in the model, the higher the valuation. But then you might lose out on credibility. So let me bring up the platform, and we can start on the valuation side if there is nothing else on this. All right. What's the company called?
The company is called Energy Pro.
Energy Pro. Nice. UK. Ltd. Right. So here I'm creating just a new company on Equidom. We have the first 10 questions, and then we're going to go into detail. So how many founders? We said 3, right? Employees, we can check. I forgot now. Let me see what. Well, we said around 30, around 30, right? We can change that afterwards. United Kingdom, okay. And then the industry. So this is one of the first hurdles, because like it's just always difficult to select an industry for a business. So
Yeah.
this one is energy monitoring, and this is like because these are is the classification from TRBC. They built it looking at the point of view of the customer. So the idea in this case is if the customer doesn't know about this company, what are they searching, right? What are they Googling? And in this case, it would be probably energy monitoring, electricity monitoring. Let's see what we have in terms of monitoring. Yeah, it looks like a commercial service, definitely. Business support service. So let's see what we have in business support services. Yeah. I can just go for business support services because it is a business support service. Again, we can take another look afterwards, and I think we should because
Would you
the industry
classify it
also.
as environmental? I mean,
No,
it's
no, no.
technically kind of reducing emissions and so on, but yeah, it's a bit marginal.
Yeah, but I think when people look for environmental services, maybe we could do other environmental services and equipment. Yeah, yeah, that's probably a better industry, and it is an industry and a commercial service anyway. So yeah, that's great. I like that. Expansion stage because we are already further than 200K. It's not growth stage, like as we said a bunch of times. Growth stage should really be a sizable company already that still is growing, and this is like, despite the 400K in revenue, is still starting in a sense. We're gonna have copyright. Okay. And when did they start? They started so they last year they were already operational. The year before as well. So 2021 maybe year of
Yeah,
starting.
yeah, seems
Yeah.
reasonable.
Not break even. This one we're gonna modify, so no problem. So this is our very quick estimate. It's a very broad number that we need to go and refine. Also because we didn't modify the financials, so we need to do that. But our process starts with the questionnaire. So this here we are trying to capture like a credible best self of the company as it is now, right? So we don't want to give a negative picture. We don't want to give an unrealistic picture. But the questions are about how the company is right now. So yeah, we said before founders invested a little bit, right? Maybe 100K. Majority of the founders is full time. The company is already pretty sizable and is paying them salaries and stuff. Given the business, they could be a bit older, right?
Yeah,
Like given the traditional side of energy monitoring. Yeah, maybe one of them has started a company before, and they have 30 employees. They work together quite a long time, and they worked in the industry quite a bit. And one of them has managerial background and experience, right? That, like, it seems like a good team in terms of also the story. Like it seems that like the story of getting into the domination fits with a good, more experienced team.
yeah, and
Right.
also pursuing something like this, it's not like low hanging fruit necessarily.
Yeah.
It would be pursued by a team that kind of knew the industry, like you said, has some experience, has some background.
Yeah. I filled in some simple answers here. Maybe the only one that creates some questions is the scalability. Like here, we're looking at the business that clearly can scale without scaling costs. So it's not like a consulting type of business or so that every time you have more clients, you also need to scale the costs. Um, we're not break even. They don't really have a structured board, but they have like a few advisors. They raise from business angels. They raise from friends and family. I don't think they did an accelerator or so. Like it doesn't seem
No,
to be the type of company. Um, Again, we're making this up, right? If you were feeling this about your own company, you would know these things without any issue, right? And if you were to do this for a client, so we also help advisors, investors, and so on, you can fill this in easily from their pitch deck. Right now, we're just guessing what makes sense with this. We're making up this story as we go. Exit opportunities. I mean, all the electricity providers, right? They are known to buy out this little software if it doesn't actually become very big.
for sure.
UK, other environmental services. The stage of the product is already into market. We have sizable revenue. The demand is tested because we have sizable revenues. The market size, we said it's a lot of companies, right? That might need this. Is basically every SME, so it's going to be a big market. I mean, shall we say like 10 billion?
Yeah,
Again, this is a little bit of research on this. Growth rate is maybe 10%. It's quite okay. Barrier to entry. Yes, the barriers to entry are not really there, right? Everybody can connect to their API. Everybody can make a dashboard. So it doesn't take much money, much time. So there aren't really big barriers to entry. Competition is maybe many small players right now. Existing competitive products are okay. And we have a different marketing proposition, but kind of everybody offers the same type of thing. There isn't really a massive competitive advantage. And competition abroad not yet developed. This goes with our story of like, maybe the rest of Europe doesn't have these APIs available yet, so there is no competition yet abroad. So yeah, we have a plan for international expansion, as we said. Average trend of feedback, sure, mainly positive. Degree of loyalty, high retention. And strategic partners are all contracted and serving high volumes. So we started in 2021, legal entity, yes. In 2021, external legal consultants, yes. Copyright, development of the IP, sure. Like it's not applicable really. Like there isn't really much IP on this. Again, here we're trying to give a picture that when we go and talk to investors, like we can justify these answers, right? So I can say IP protection secured at a global level, and then I get a question like, what is the IP? And I have to say nothing, right? Apart from some code. So I don't want to get that question afterwards. So that's why I say not applicable here. The relationship with the company values. So let's say we are the founders, right?
yeah.
Like we are kind of valuing it as if we are the founders. And for the purpose of fundraising, the company is not traded on a blockchain. All right. So that's the questionnaire, fairly simple. What's going to make a difference in the valuation in this case is mostly the financials, as the company is more developed. Did you see anything in the questionnaire that was sort of creating questions or like that could be strange that
The
we
only
didn't
thing really
cover?
was market size is kind of a tricky one. Usually there's
Yeah.
reports that people can look up and find that data. But yeah, it's kind of controversial, but also doesn't have an effect on the valuation at the moment, right?
No,
Directly, at
right now it
least.
doesn't. It might have soon, but the even in research, the effect of the market size is not really proven because some small markets like they grow up to become huge, like Airbnb type of things, and some other markets are huge, but they're so competitive that it's almost pointless to understand the fact that they're huge. So
Yeah, Airbnb is a great
yeah.
example.
Yeah, market that this didn't exist before, and now it's one of the largest companies in the world. All right, so here I'm uploading our financials, right? So the Excel sheet that we made before, just to speed up the process, we can just import all the results and we have them here. We can save, so then everything gets filled out by the platform in terms of profits and calculations and cash flows and so on. We have all our years here. So right now we are doing the valuation with 1 year of past data and then 5 years of future projections, right? The let's just finish the valuation before we get into commenting it, I would say.
Sure.
So funding, we are raising 2 million, we said, which is pretty much going to be split 50-50, right, in sales and product, maybe like 70-60 product.
Yeah, makes sense.
And we already did one round, an equity round for 400K. For 400K of investment at a valuation of probably like 2 million, something
Six
like that.
million, maybe less.
Pre-seed,
Yeah.
UK, maybe 3 with the experience of the team. Again, you would know this if you actually were this company.
Yeah.
So that's about 12% stake. Is it? No, it's more like 14% stake. And we did this in about a few years ago, right? In June 22. Okay. No, in 23. April 23. Okay.
Yeah, makes sense.
Save. Now we are August 24 for reference. So, okay, this is in a negative valuation. That's unlikely because we don't have the right numbers here. Let me try to upload it again. All right. Okay. Yeah, we're gonna have to look at the Excel 1 second. But what else do we wanna see here? Advanced multiple, advanced settings. We can look at them when we check the valuation itself. So the only thing that we need is to fill out the company side, which is really descriptive, and that is not. It doesn't impact the valuation, but we can have here our description, website, and address, and things like that, as well as the competitors and the shareholders. Now we're not going to do it for the purpose of this exercise, but it helps to finalize the report and to make it look professional, right? The report then is going to be downloadable here, but first we need to look at the Excel file and understand the numbers. So we'll fix that and we'll come back. Okay, so cut. So we're back. We had to configure the Excel a little bit differently for the upload, but now we have the right numbers and we can import them and we can save. And now our valuation should not be negative. Okay, so we have a preliminary valuation of 3.4 million, and now we can go think about it, right? So we are raising the 2 million. So if we raise the 2 million at this valuation, we're going to have to give investors 37%, which seems a bit high, right? In the sense that if we need to do another round after that for 10 million to go into Europe, we're going to get our like 3 founders are already going to be 21% each. After another round, they're going to be even lower. So that's kind of the trade-off that we don't want to lose sight of, is the fact that founders end up with so little capital, so little like percentage of the company, that they don't have an incentive to actually put in the high effort and the strong effort to make the company successful. If we look at this valuation, we see that on the qualitative methods, so these two methods are based on the questionnaire and they're based on comparing the startup with other startups. Based on these two methods, the valuation would be higher, but then based on the financials, it would actually be lower, right? So that's, if we want to adjust this valuation, that's where I think we should start. And
The implication of the 5 methods basically looks to me like the qualitative methods are saying that it's a company that should have a lot of potential, but the financial methods are saying it's not delivering on that potential in like returns and in future
Yeah,
in revenue.
yeah, 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 exactly. And I think like when we see numbers like this on Equidom, like a little bit simplified, you can see that okay, if we're raising 2 million now, and then we are returning 2 million in EBITDA in 5 years, like that's not a lot of return
Mm-hmm.
for the current risk of the company. I think with this company we could go both ways. There could be a way, maybe like the mistake that we did was to include costs as if we were going into that big expansion into Europe, especially near 4 and 5, but we didn't include revenue to that expansion, right?
Mm-hmm.
So then we end up with a margin on the last year's an EBITDA margin of about 20% for a company that is like pure software, which is maybe a bit on the low side. Um,
It's an
and
interesting thought exercise, right? Because you go through this, you see the resulting valuation, and it's basically telling you like you could raise money from venture capital, but like if you really want to make it a viable, promising situation, then you have to be a bit more ambitious, basically.
yeah, 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 and it's a balancing act in the end, right? So everybody,
Mm-hmm.
founders, investors, employees, and customers, they need to have the right incentive to interact with the company in order for the company to work out and be effective, right? So
Mm-hmm.
um, yeah, I mean, I think like what I would do here is go back on the projections, and probably I would include the revenue of expanding into Europe in year 4 and 5, and then maybe have the costs a little bit increase, but really show off that what's going to happen then, and then go for that the higher valuation. Or what we could try to do is we could try to remove 1 year, and then in this case, what happens is that the no, this actually lowers the valuation. So okay, so that's not a viable strategy. Um, yeah, so that's probably like the main thing to do. And as always, like these are the if you fill in these assumptions, and even if you talk with us or talk with fellow founders or so, like you're always inserting only your assumptions, then the question is going to be how much are they going to be believed by the other side, and then you can always come back and adjust based on the feedback that you get, right? In this case you would probably get the feedback, if you go with these projections, you would get the feedback from investors of maybe like the opportunity is not big enough for them, or
Mm-hmm.
maybe that you are raising too much capital for this opportunity, because the returns are not there, right? And those are both valuable strategy. You could increase the opportunity, or you could say like I go after this opportunity, but I go after it in a bit of a more leaner way in terms of costs, and so you're going to have higher margin, and then you don't have to raise 2 million, you might raise only one, and still go after this type of revenue. So because these are all assumptions, like the point of this exercise is to try to come together and have an agreement on these assumptions that allows the company to be successful and to be financed as well.
If you were
Um,
to reduce the amount of capital being raised and therefore reduce the kind of opportunity cost for the investor, does that change the valuation?
So like it changes the valuation because it changes the story, right? So if we let's try that, right? So we raised 400K so far. We raised it during COVID, which everything was amazing, right? So maybe we raised a little bit more than what we were supposed to. Like
Mm-hmm.
in a normal period, we would have raised maybe 200K, right? And we would have just done an MVP, right? So right now we went back to a normal period, and raising those 2 millions on that crazy, not crazy, but on that very ambitious story is harder. So instead we're raising only 1 million, right? But we're still going after the same opportunity, but it's gonna take us a little bit longer time, right? So I'm gonna make some simple corrections now. This should be done in Excel, but just for sake of time, right? So let's say we go towards a story that is more on the like a little bit slower, right? So 8 there and then 5 here. So just a little bit slower end point, but then we go after it in a much leaner way, right? So this one is going to be like 600, maybe 800, and then 1.4, and then
I kind of think the
2.
projections were maybe already showing, on the
2.
scale of things, a slightly conservative outlook compared to the 2 million that was
Yeah,
being raised.
yeah, maybe, and that's why the valuation maybe was like on that side.
Hmm.
Um, yeah, let's see. Let's see what happens like this, and then we can ponder that and bring back the. Oh no, that's wrong. Bring back the revenue if we need to. So this is like a much more conservative plan. Again, just this should be done in Excel, and like we should change the actual numbers, but then we get to a totally different valuation. Well, this is even too much, right? We got a very high margin here. We got like 60% margin, so that's definitely not correct. So maybe
I can
we
see it's
should increase
also like
more. But
auto-filling inventory, which maybe we would get rid of.
yeah. So like the working capital itself now it's actually consuming some capital, but not that much. So it's only
Hmm.
190K. But yeah, if we were to do things properly, we would probably not have inventory because the soft is a software business,
Hmm.
and you'll see like the change here should be fairly marginal. Uh, but we have okay, so we have to adapt also all the other values because otherwise this is not going to work. Uh, so this is an estimate, right? Again, this if especially if you do projections of a company of this scale, you should have these numbers like from your projections, not from an estimate. What Equidam does in this case is we do an estimate from the industry average, but the industry average, especially when you look at the industry that we have, like environmental facilities and services, is going to have vastly different numbers compared to a pure software play in that industry, right? So
Hmm.
the idea here, I think, would really be to have your own numbers for receivables and payables, which can be calculated fairly easily. We have helpers here that explain how to estimate them, and they're fairly easy to do. But yeah, like this, we get to a working capital, a positive working capital, and a valuation of around 9 million with a company that is very profitable fairly soon, right? And a bit of a smaller play. Again, random numbers, but interesting still to see this type of vision, right?
Hmm.
Um, we
I mean,
still
now to me,
have,
it's looking more like a startup essentially. Like it's running a bit leaner. Maybe the growth isn't quite
yeah,
as like exponential as it could be, but it's certainly running leaner. The growth in EBITDA is a lot more
yeah,
promising than it was originally.
yeah, yeah. And so here, I think um, the comment that an investor would have is if the company is already profitable, as you can see here, then why are you raising capital? Um, which makes sense. And like the same question correlates with maybe a slightly high valuation of 9 million when you're raising 1 million.
Hmm.
So 10% for investors right now. But it could be that the opportunity is very good in this case, and that the data of the company and the traction of the company is already proving all of this, right? Again, the real test of these assumptions is going to be with investors, right? So speaking with a couple of investors that are not the top selection, and then see what is their feedback, especially in terms of potential risk and return of the company, and then adjusting it. It gives you a very interesting feedback that you can work on. Um, all right, so we got to a basic valuation, right? Um, which, if these are the numbers, it could be a starting point for those investor discussions. I would argue. Um, like I think it maybe in interest of time, we generate a report, and like this could be the first report that you discuss with like the first couple of investors, and and for today we're kind of done, and then we can do another video on how to get into like more advanced topics like multiples, advanced settings and benchmarks. But this is the process on how to get to the first valuation. So we just generated a valuation report. All right, and here we have the report. So this is the outcome of the process, right? And it doesn't necessarily need to be shared straight away with investors. Like, it's always good to ask investors what would be their range of valuation for a company like this and stuff. But it gives you an idea. It packages everything that you saw on the dashboard, but it also has a lot more information, and it has all the assumptions about the company, the future forecast, the past funding rounds, and the current ownership, and then really the valuation as we saw it before, with its low bound and high bound, the 5 methods, and then we have a page for each method, and then explanations and so on, and then at the end also the financials and the full appendix. So we have actually a video explaining the report and how to use it. But the idea here is that at this point you are ready, right? You're ready to use this in conversations and to discuss it and stuff. The point of view here is always like, okay, this is the valuation based on these assumptions. Let's see if we can get together with investors and understand the future of the company in terms of its potential and its risk, come together on the assumptions, and we should also come together on the valuation. So at this point you are ready to go.
Yeah, I think it would be good to do a part 2 for this, where we talk about dealing with the investor feedback you might get to this report, addressing some of that through, maybe changing some of the parameters, maybe putting together a slightly more sophisticated multiple, doing some benchmarking, all things you can do within the platform to help, align both sides, help solidify the valuation, and help, eventually get to fair terms.
Yeah. If you want to see that, stay tuned. Subscribe to our YouTube channel and comment if you have any questions or any comments on what we said during this video. Please leave them in the comment section and we'll address them and maybe make more videos about them as well.
Absolutely.
All right. Thank you very much.